Hi, so this is what we are going to be looking at today, how to calculate both in volume and units of our contribution. We had earlier dealt with basic assumptions underlying cost volume price CVP, and after now we'll be looking at how to calculate our break-even analysis. We are going to look at how to calculate break-even points. We are going to look at how to derive margin of safety and also target price. And of course, we are going to look at costs, contribution, sales ratio. We are going to look at that. So without further ado, for those that are just joining us, I say, hi, my name is Gbenga Olatunji FCA. So we move without wasting time into the business of the day, which is how to calculate our contribution both in volumes and in per unit, in units. So we have this question. I hope we can see it. I quickly run us through it. We have a company that makes and sells a single product. The product has a variable production cost, which is 8 could be naira, in dollar, in pounds, or wherever you are looking at me, your currency, and a variable selling cost of 1 pounds or 1 naira. Also, we have a fixed cost, and quickly in our introduction video we made mention that CVP is calculated using marginal costing approach, not absorption costing approach. So the fixed cost of our production, admin and distribution is fixed for 500,000, and selling price per unit is 16. So we have a profit on the volume of 70,000, 80,000 and 90,000 units, upon which we are to calculate in volumes our contribution. Then we use it to get our sales per unit. Are we ready? So let us go. Like one of my lecturers, we used to say, we do it together to make it sweeter. So sit down with your calculator and let's go and calculate. Now we have our volume sales, which are these, so which I just put. Now we want to calculate our selling price. Our selling price, we've been given the volume to be 70, so, and our selling price to be 16. So we have 16 multiplied by our sales volume, which is 70. So we have this, and we can derive both for 80 and 90 volume. So that is that. Then let us look at our variable costs of production. Variable cost of production, that's this. So now variable selling, variable production costs have been given to be 8. So we'll say 8 multiplied by our volume at 70, at 80 and at 90. So we have this. Then let us equally look at our variable cost of selling, selling cost, variable cost of selling the product, which is this. We were given to be 1, so that is easier for us, right? So we just say 1 multiplied by, so easy. Like I overheard conversation between a lecturer and the like, so there is no confusion. The student were the point of confusion, and the lecturer was like, there's no point of confusion. So no point of confusion. Let's continue. Now we want to calculate our variable costs, total variable costs. Our total variable cost will be, figure marshals, give us will be what? So we need to add this to this, right? We need to add this together. We need to add this together. Are we together? So let's quickly do that to have our total variable cost. So we said the sum of this plus this. So we have this, and we can know for 80,000 units and 90,000 units. So we can now say this is our variable cost, right? So having calculated our total variable cost, let us know what our contribution will be. What our contribution will be now. So, and what is contribution? Contribution simply is sales, which is this, minus our total variable cost. So we have 490 when we produce at 70,000 capacity and the like. So this is our contribution. Let me put it in another shade of color. Okay, can we see it? Now we can, this will be our total profit. Now we can say, so I will not confuse you. Our fixed cost now is what? 500,000. Our fixed costs have been given to be 500,000. So we just put 500,000 for everyone here. Now we want to know our profit per volume of production, which is to do what? To minus fixed cost from our contribution. So for 70, we are going to say we minus 490,000 from, of course, it's going to give negative, right? So these ones will be giving us negative. Can we see it? So we can spread it for 80,000 capacity and 90,000 capacity. So we are having now as our profit negative, which simply means we cannot break even. We have a loss. So if we want to break even, we must make and sell more than 70,000 units. Do we understand? And in between now, since I'm already getting ahead of, but it's good so that you can understand. If we are to break even at all, is going to be between the production of 70,000 units and 80,000 units. Do we understand? And do we agree as to that? It's going to be between this. So this is about the volume calculation. Now let's quickly look at how to calculate in our unit. How to calculate in units. We want to deal with calculation in units. Basically, we are adapting the same thing, except that our sales now will be in units, not in volume. And our sales figure was given to be what? We have 16, right? So I put 16 here, and our selling price per unit is what? Our total sales, don't let us use this. Our selling price is 16 because we are not going for volume again, and our variable cost of production has been given to be the product as a variable production cost of 8 has been given to be 8, and our selling price has been given to be 1, right? So our total variable cost now is the addition of these two, which will give us 9, and it will take 9 away from our selling price per unit. Our selling price per unit, we are going to have, okay, let's quickly do our contribution. Our contribution is what? Our contribution, because that's the main thing we want to do. Our contribution will be 16 minus our total variable. Don't forget that So this is we have 7 as our contribution per unit. We have 7 as our contribution per unit. It could be in whatsoever fixed cost. We can calculate it, but we already have it here. So let me delete this. I'm going to do something now so that we know that whether we get it right or wrong. You know, this is our contribution per unit. So now for volume of 70,000 now. For volume of 70,000, are we together? Let us multiply by let's multiply by 7. You remember 7. So we have 490. We have 490 here now. Are we together? We have 490 here. We have 490 here equally. We have 490 here. So that simply tells us that this figure is correct. This figure is correct. Likewise, at 80,000, so for exam purposes, if you have time, since we have our contribution to be 7, you can multiply to be sure you're correct with the volume 80, which is 80,000 here. So 50, 560, we have 560 here. Can you see it's changing? We have 560 here. So let us do the last one, or should I give that one as an assignment for us? So quickly convert. We want to check whether we are correct with our unit contribution. $7, 7 naira, 7 pounds multiplied by 90,000 capacity. What do we have? 630, and we have 630 here too. We have 630 here too. So for us, if we are not subscribed to GJAMES Associates, what are we waiting for? Click the notification and subscribe. My name is Gbenga Olatunji FCA. Next, we want to be discussing and dealing with our margin of safety, how to calculate the margin of safety, how to calculate our break-even point, how to calculate break-even analysis, and also targeted profit. Don't forget, if you are watching this video and you were not in class as at the time we did the assumptions, go for assumptions video. I'm going to put it at the end of this video too, or at the description. And for any reason, if I forget by the time I'm uploading, you can comment, and I'd love to hear from you. Please let us hear from you. It's good to hear from one another. Next, we'll be dealing with break-even analysis from GJAMES Associate channel. We have value to life. I want to believe you've enjoyed value. Click subscribe, click now like, so that the algorithm will pick it up and distribute it to other people that needs to understand we are value to your businesses.